Hey photographers, I know one question that comes up for a lot of us is, what tax bracket am I in? Understanding tax brackets can make a big difference in how you plan your finances and how much you end up paying Uncle Sam. Today, I'm going to break down what tax brackets are, how they work, and how your filing status can impact which bracket you fall into. By the end of this video, you'll know exactly how to navigate tax brackets and make smarter decisions for your photography business. Hi, my name's Heather, and I'm a wedding and senior photographer based in PA. On this channel, I love educating other photographers about taxes and finances as a small business owner, and I'm so excited you're here. In this video, we're going to dive into one of the most important topics when it comes to your taxes, tax brackets. This video is brought to you by my free masterclass, Maximizing Your Tax Deductions as a Photographer. In this masterclass, I'll walk you through the 5 most common tax deductions that photographers miss when preparing for tax season. I'll give you actionable tips so you can maximize your deductions and keep more of your hard-earned income. You can find a link to this class down in the show notes. Now, let's dive into understanding tax brackets. So first off, what exactly are tax brackets? A tax bracket is simply a range of income that gets taxed at a particular rate. The U.S. federal tax system is progressive, which means the more you make, the higher the percentage of tax you pay. But it's not as simple as saying, I made $50,000, so I pay 22% tax on all of it. Instead, different portions of your income fall into different tax brackets, and each portion is taxed at a different tax rate. This is known as a marginal tax system. You're only paying the higher rate on the income that falls into that higher bracket. So just to hit it home, let's say you're in the 22% tax bracket. This doesn't mean all of your income is taxed at 22%. Instead, only the income that falls within that bracket is taxed at 22%. Your lower income is taxed at lower rates like 10% or 12%. Now, your filing status plays a big role into what tax bracket you fall into. There are 3 main statuses we're going to go over today. That's single, married filing jointly, or married filing separately. When you are single, you're using the tax brackets for single filers. Let's say you make that $50,000 as a photographer. You'll fall into the 22% tax bracket. But remember, that doesn't mean all of your income is taxed at 22%. The first $11,000 is taxed at 10%. The next portion, which is $11,000 to $44,725, is taxed at 12%, and only the amount above $44,725 is taxed at 22%. So it's separated into different sections. If you're married filing jointly, the tax brackets are more generous. The thresholds are almost doubled compared to single filers. For example, for 2024, the 12% tax bracket for joint filers applies to income up to $89,450. So if you and your spouse have a combined income of $80,000, you'll still be in the 12% bracket. This can really work in your favor if one spouse makes significantly more than the other, or if one spouse runs the photography business while the other has a full-time job. The combined income could fall into a lower bracket, reducing your overall tax bill. But what if you're married and choose to file separately? Here's where things get a little tricky. When you file separately, your tax brackets look more like the single filer brackets, but there are additional restrictions. For example, you won't qualify for certain credits and deductions that joint filers can claim, like the earned income tax credit. For photographers, married filing separately typically results in paying more taxes overall overall. So it's usually better to file jointly if you can. However, if your spouse and you have very different income levels, or if one spouse has complicated tax issues, filing separately could be beneficial. So I just wanted to mention it. Okay, so now that you know what tax brackets are and how they work, what does this mean for you as a photographer? Well, it affects how much of your income you get to keep and how much goes to the IRS. But it also opens up opportunities for tax planning. As a small business owner, your taxable income is your gross income minus any deductions and expenses you claim for your business. So say you made $60,000 from your photography business in 1 year, but after expenses like equipment, travel, home office deductions, and so many more, your taxable income is reduced down to $44,000. If you're single, that would put you in the 12% tax bracket for most of your income instead of having to pay any portion at that 22% rate. Remember, the key is to know that tax deductions and write-offs can lower your taxable income, which could push you into a lower tax bracket, saving you money. Understanding your tax brackets can also help you plan for the future. As your photography business grows, your income will hopefully increase as well, which means you'll move into higher tax brackets. But don't panic. Higher tax brackets don't mean all of your income is taxed at that rate. And with smart financial planning, you can reduce your taxable income and maximize your deductions. For example, let's say you're looking at buying new gear. You could time your purchase for the end of the year, which could help lower your income for that tax year, keeping you in a lower bracket. Or you could contribute to a retirement plan, which can lower your taxable income as well. Now, let's talk about some common mistakes photographers make when it comes to tax brackets. One mistake, which we sort of hit on already, is assuming that earning more automatically means paying way more in taxes. Remember, only the income that falls within each bracket is taxed at that rate. So you're not losing half of your income just because you moved into a higher bracket. Another mistake, not planning for taxes throughout the year. I always recommend setting aside a portion of your income for taxes as you go. Trust me, that tax bill at the end of the year and even the ones throughout the year can sneak up on you if you're not prepared. Set aside 25 to 30% of each of your paychecks to cover all tax payments. Then after your annual taxes are paid, if you have some left over, you can give yourself a bonus as a pat on the back for planning ahead. So to sum it all up, tax brackets might seem intimidating, but once you understand how they work, they can be an asset to keeping more of your hard-earned money. By knowing how much of your income is taxed at each rate, you can plan smarter, keep more of your money, and avoid any surprises when tax season rolls around. If you're still feeling a little confused, don't worry. Talk to a CPA or tax professional, and they'll help you navigate the ins and outs of tax brackets and make sure you're taking advantage of every deduction possible. So just as a reminder, tax brackets are progressive, meaning only portions of your income are taxed at different rates. The more you make, the more you'll pay, but not all at the same rate. And using deductions and smart planning to lower your taxable income can help you keep more money in your pocket. Thanks for sticking with me through this video. If you found this video helpful, be sure to like and subscribe for more tips on managing your photography business finances. And if you have any questions, feel free to drop them below in the comments. I'd love to help. Don't forget to sign up for my free masterclass, Maximizing Your Tax Deductions as a Photographer, so you can gain a clearer understanding of how to optimize your tax strategy and feel more confident about managing your finances. Thank you again so much for joining me this week, and I can't wait to see you in the next one. Bye, guys.